Welcome to this ValueBridge.net case study. This time we'll use the site's models to estimate the equity return impact of certain ESG initiatives in private equity deals. Specifically, we'll model ESG investments that increase the fixed cost of doing business, but also increase a portfolio company's valuation, so there's a trade-off with a break-even point that we can identify with a fairly simple equation. Here's a factory that's churning out products but also burning carbon. So let's make it run cleaner. We'll add a few solar panels and a wind turbine, and now it's pumping out good vibes instead of CO2. However, major conversions like this have costs. More expensive facilities will increase the company's SG&A, and this is generally not good because it reduces the company's EBITDA. Holding other factors constant, this would decrease the company's enterprise valuation, which also has the effect of reducing shareholder equity value. But wait, not so fast. According to our consultants, our pivot to ESG-friendly manufacturing has made the company's EBITDA worth more. We might increase the company's valuation multiple enough that we flip the company's enterprise valuation positive despite the EBITDA decrease and actually cause shareholder equity value to grow. Let's see an example of how this can work. Here we have a company that's worth $100 million. It's capitalized with 50 of equity and 50 of debt, so its equity and debt ratios are both 50%. According to the company's income statement, TTM revenue is 80 and cost of goods sold is 32. So this provides $48 million of gross profit and a gross profit margin of 60%. Next, we have SG&A of 28. This leaves us with $20 million of TTM EBITDA and provides an EBITDA margin of 20 over 80 or 25%. For this analysis, we'll also define a term called the operating expense margin. It's the SG&A over the revenue, which is 28 over 80 or 35%. And at the bottom, we have the company's EBITDA valuation multiple of 5.0 from the enterprise valuation of 100 over 20. Okay, now let's keep as many of these metrics as possible constant, and then layer on the ESG expenses to see how they influence the capital structure and P&L. So we'll keep the company's debt level the same, and also not change the top half of the income statement, including revenue, COGS, and gross profit metrics. And for now, we'll also keep the valuation multiple constant. Let's say that the ESG investments cost the company $4 million per year, and this increases the company's SG&A to $32 million. This would increase the operating expense margin to 40%, reduce EBITDA to $16 million, and reduce the EBITDA margin to 20%. That would make the enterprise valuation 5 times 16 or $80 million, which makes total shareholder equity fall to $30 million, and provides the following equity and debt ratios. This represents a loss for the shareholder group of $20 million or 40%. A value bridge can quantify the cause of this change, so let's add the necessary data, the differences, averages, and equity return multipliers as follows. Gains and losses from changes in fixed costs are explained by operating margin reduction. This is minus the change in the operating expense margin times the average holding period revenue, valuation multiple, and equity ratio. Plugging in the numbers on the table gives us minus $8.75 million. Now, this is short of the $20 million equity loss because we're missing gearing. In a levered deal like this one, debt on the balance sheet amplifies equity gains and losses. Gearing is the change in the enterprise valuation minus 20 times the average holding period debt ratio of 56.3%. That's equal to minus $11.25 million. And these two numbers add up to the correct total equity loss of minus 20. Okay, now let's clear this whiteboard and allow the market to respond to the company's cleaner and greener positioning. Given the high demand for ESG among institutional investors, will increase the company's valuation multiple from 5 to 7 times EBITDA. That makes the enterprise valuation 7 times 16 or $112 million, and since we still have net debt of 50, the total shareholder equity value would increase to $62 million and provide the following equity and debt ratios. This time, the overall impact of the ESG investments increased shareholder equity by $12 million or 24%. To quantify the value drivers, we measure the differences, averages, and equity return multipliers just as before. Multiple expansion is the change in the valuation multiple times the average EBITDA and equity ratio. Plugging in the numbers on the table give us plus $18.96 million. Operating margin reduction is calculated as before, providing a loss of minus $12.64 million. And since this time we increased the company's enterprise valuation, we have a positive gearing of plus $5.68 million. We see that these three value drivers add up to the correct total shareholder gain of $12 million, so we can rearrange them into a value bridge like this, which explains the difference between the pre-ESG equity valuation of 50 and the improved post-ESG equity valuation of 62. Now, we must say that this is an illustrative and oversimplified example. But our models are equipped to deal with much more complicated situations. If you download the Excel file on the case study page, you can also see what happens when ESG investments influence company debt and cash flow levels, revenue, and variable costs. But when we limit the model to just a few factors like SG&A and valuation here, it can help us to identify hypothetical break-even points and estimate the amount of multiple expansion that we may need to make up for any given increase in the company's fixed expenses, whether that's from ESG or anything else. So let us define a fund or GP's gross multiple of invested capital as the fund's equity value at time 2, that's after the ESG investment, divided by the value at time 1, before the ESG investment. According to the logarithmic model that we discussed on the site, this is equal to the product of the revenue at time 2 divided by the value at time 1, the EBITDA margin at time 2 divided by the value at time 1, the valuation multiple at time 2 divided by the value at time 1, the equity ratio at time 2 divided by the value at time 1, and the fund ownership percentage at time 2 divided by the value at time 1. Since we are looking to identify a break-even point, we'll first set the gross multiple of invested capital equal to 1. And then from here we can make a few other simplifications. In this example, the revenue doesn't change, so that term goes to 1, and there's no reason to change the GP's ownership percentage, so that can go to 1 as well. Now, the equity ratio is important because that can lead to gearing, which we saw in the previous examples. It can be material, but in this example, gearing only happens because it's downstream from changes in the EBITDA margin or the valuation multiple. So for the purposes of this break-even analysis, we can also set this to 1. This leaves us with a formula where the product of EM2 over EM1 and M2 over M1 must equal 1. If we solve for the valuation multiple after the ESG investment, we see that it's equal to M1 times EM1 over EM2. Now, EM2 is our EBITDA margin after we invest in the ESG initiatives. We can write that as the EBITDA minus the ESG costs all over revenue. That's equal to the original EBITDA margin minus the annual cost of the ESG initiative divided by the company's revenue. And plugging this into the denominator provides the break-even equation for changes in the company's valuation and SG&A. So, back to our original example. How much does a company need to be worth to make up for the annual $4 million expense caused by the ESG initiatives? Well, the initial valuation was 5.0, the EBITDA margin was 25%, and the $4 million expense on a revenue of 80 represents a 5% decrease in the company's EBITDA margin. So 5 times 25% over 20% gives us a break-even valuation multiple of 6.25. In this example, we needed to increase the company's relative valuation by at least 25% to make up for that relative increase in the company's SG&A. I hope that you found this helpful. Check out the case study page at valuebridge.net where we lay out all the math and provide a Microsoft Excel template that you can download. Don't hesitate to reach out to me if you have any questions. Thanks for watching, and see you next time.